Welcome to the Explainer today. We're going to build a complete blueprint for one of the most fundamental tools in all of trading, the trend line. You know, so many traders draw them, but very few really master them and that well. That leads to a ton of confusion and some pretty costly mistakes. It looks so simple on the surface, but trust me, when you use it correctly, it is incredibly powerful. Okay, let's dive right in. We are going to build a repeatable process right from the ground up to help you read the market's flow with real confidence, all right? First things first, before we get into any strategies, we've got to get the basics down cold. So what exactly is a trend line? And what are the two main types? You're going to see all the time. Getting this foundation right is everything. So at its core, a trend line is just a line drawn on a chart that connects either the swing highs or the swing lows. Think of it like this. It's a visual roadmap for the market's momentum. It helps us see the story of who's in control, the buyers or the sellers. And it breaks down into two really simple types. In an uptrend, what do we see? Price making higher lows. So we connect those higher lows below the price. And that line acts as a kind of moving floor, or what we call dynamic support. On the flip side, in a downtrend, price is making lower highs. We connect those peaks above the price. And now the line acts as a dynamic ceiling, or resistance. Makes sense, right? Okay, moving on to the rules of drawing. Now, pay attention here because this is absolutely crucial. A lot of people think drawing trend lines is some kind of artistic guess. It's not. It's a skill. And it has clear rules that honestly separate the pros from everyone else. So here are the 4 big rules. Step 1. You need a minimum of 2 touches to even start a trend line. Step 2. The more touches, the stronger the line. A line that's been respected 3, 4, 5 times. That's a line you need to pay attention to. Step 3. And this one's huge. Don't force it if you have to squint and tilt your head to see a trend line. It's probably not there. The best ones jump right out at you. And finally, step 4. Think in zones. This isn't a laser-thin wire. It's more like a general area of interest. The market's messy, so treat it that way. Okay, here it is. The big question. I get asked this all the time. Do you draw the line through the candle wicks or the bodies? It's probably the single biggest point of confusion for traders, but the answer is surprisingly simple. And the answer is, you always draw your trend line where you can get the most touches. That's it. It's that simple. It doesn't matter if you have to cut through a wick here or touch the edge of a body there. The goal is just to maximize the number of contact points. That's what makes the line valid, not some perfect rule about wicks versus bodies. Okay, on to our first strategy. The bounce. This is all about trading with the trend. Now that we know how to draw them properly, let's put them to work. This is all about working with the market's momentum, not against it. And to make this strategy even more powerful, we look for something called confluence. What's that? It's just an area on the chart where multiple signals line up. Think about it. Maybe your trend line crosses paths with a major horizontal support level. When that happens, you found a high probability zone because now you've got different kinds of traders all looking at the exact same spot. So here's the setup. You see the price moving back down towards your beautiful multi-touch uptrend line. And not only that, it's approaching a high confluence zone. Everything is pointing to a potential bounce. So what do? Do we just jump in? Place a buy order right there on the line and just hope for the best? No, absolutely not. We wait for confirmation. Look, this is one of the biggest lessons in trading. We react, we don't predict. We need to see proof that other buyers are actually showing up at our level before we commit. And what does that proof look like? Well, we're looking for specific confirmation signals. Maybe it's a bullish rejection candle, like a pin bar with a long lower wick. That's the market literally rejecting lower prices. Or maybe a big, powerful engulfing candle swallows the previous one. These are your green lights. They tell you, okay, the bounce is real, all right. Let's flip the script with strategy number 2, the breakout. We all know trends don't last forever, right? So, let's look at how to use trend lines to spot when a trend is about to die and a new one might be starting. The first warning sign is pretty obvious. A break of the trend line. This can be an early signal that the whole game is about to change. But, and this is a big but, you have to be super careful here. Not all breaks are real. Many are just fake outs or traps. A price simply moving across the line isn't enough. So we need a confirmation checklist for our breakout. First, look for a loss of momentum in an uptrend. Has the price failed to make a new higher high? That's a huge clue that buyers are running out of steam. Second, look for a classic reversal pattern. Is a double top, or maybe a head and shoulders forming before the break? When you see these clues first, the actual trend line break becomes so much more meaningful. So let's put these two side by side. With a bounce strategy, your goal is simple. Trade with the current trend. Your mindset is the trend is my friend. But with a breakout strategy, your goal is to catch the start of a new trend. Your mindset has to shift to the trend is ending. It's two completely different ways to use the exact same line, all based on context. Okay, finally, let's add the pro-level step that ties everything together. This one habit can seriously increase your odds of success. And it's all about seeing the bigger picture. The rule is simple, always, and I mean always, check the higher time frame to make sure you're aligned with the big picture trend. If you see a great buy setup on the hourly chart, you better check the daily chart. Why? Because you don't want to be buying into a small rally when the daily chart is in a massive free fall. That's like trying to swim upstream against a powerful current. Okay, let's boil it all down. If you remember nothing else, remember these 5 points. 1. Draw for the most touches. Forget the whole wick versus body debate. Think in zones, not perfect. Lines. 3. Confluence is your best friend. 4. Always wait for confirmation. Don't jump the gun. And 5. Check that higher time frame to make sure you have the wind at your back. So now you have the map. Question is, where will the market go next? By applying this blueprint, you're not just guessing anymore. You're actually reading the story that the chart is telling you. Thanks so much for watching. Welcome back, warriors, to Edward Trading Club. The biggest mistake most traders make is staring at price action while ignoring the most critical factor: trading session cycles. You can have a perfect setup, but if you execute in the wrong session, you become the liquidity. Trading is a battle of timing. Today, I will decode the structure of the Asia, London, and New York to show you how institutions program liquidity traps. It's time to stop being the bait and start thinking like a hunter. We begin with the Asia session, the accumulation phase. This is when the market moves slowest as Western liquidity is offline. But don't let this quiet period fool you. This is when market makers quietly engineer a tight range to create a false sense of security. They are building the bait by inducing traders to cluster stop losses just outside the highs and lows of this range. The Asia session is not for trading, it is for identifying exactly where the trap is being set. As London opens, the beast awakes. This is the manipulation phase, known as the Judas swing. The market typically executes a fake breakout past the Asia range to entice the crowd into chasing the move. This sweep serves two purposes: clearing out existing stop losses and using that liquidity as fuel to drive the real daily trend. When you see price sweep the high or low followed by a violent rejection, that is the footprint of smart money taking control. Finally, we reach the New York session, the distribution phase. This is the peak of daily volatility due to the session overlap. The key rule to remember is the New York reversal. If price overextended during London, institutions will begin taking profits as New York joins, causing a sharp U-turn. Most traders get trapped buying the top because they blindly follow the old trend, unaware that the daily cycle is complete. This is the time to look for exits or short-term reversals. Why do we wait for the sweep of the Asia high and low? Because that's where the money of retail traders is located. They usually place their stop losses just above the high or below the low of that box. The market will push price through these levels to grab liquidity, like refueling a car, before the real move begins. Grab your pen and write down this battle plan. We never predict, we only react. Step 1. Identify, plot the Asia high and low precisely. This is your target liquidity zone. Step 2. Patience, stay disciplined. Never trade inside the Asia range box. Wait for London or New York to sweep these levels. Step 3. Confirm, watch for a rejection candle. If price sweeps out and immediately rejects, leaving a long wick and closing back inside the range, that is your entry signal in the opposite direction. In trading, money is simply transferred from the impatient to the disciplined. Once you master session cycles, the market becomes a systematic wealth machine. If this knowledge shifted your mindset, support Edward Trading Club with a like and subscribe. Join the trading room via the link below to trade live with us every day. Stay sharp, stay disciplined. All right, today we're tackling gold. You know, it's one of those assets that people either love or hate, and it can be incredibly confusing. So let's try and figure out what really makes it move. You know, I love this quote from a veteran trader. It just hits the nail on the head, right? It's like that big bowl at the party. It's really hard to stay on. For a lot of people, gold just seems completely random and volatile. It's like trying to stay on a bucking bronco. Those moves can be so sharp and sudden, they just throw you off. But here's the thing, there is a logic to it all. It's not just random chaos. So we're going to break it down into 5 simple steps. We'll start with how it moves and end with what's really driving it deep down. Gold, a wild ride. The first thing you absolutely have to get about gold is that its price action isn't random at all. It actually has this very specific kind of two-speed personality. So for most of the time, and I mean this could be for years, gold just does nothing. It just bounces around sideways, not really making any big moves. And then bam, out of nowhere, it just explodes. We're talking a massive, relentless one-way move. And it's this dual personality that really catches everyone by surprise. 2. The fundamental engine. So the big question is, what causes those explosions? Well, like I said, they're not random. They are absolutely driven by economics. The exact same fundamental forces that move things like the stock market or the US dollar. And this is so important to understand. You might think fundamental analysis is just for stocks, but nope, it is absolutely crucial for gold. Seriously, the pros live and breathe this stuff. They're constantly watching the economic data to try and figure out gold's next big move. So what kind of fundamentals are we talking about here? Well, it's the big stuff: interest rates. What central banks like the Fed are doing. Are they hiking or cutting? We're talking about geopolitical stuff like wars and instability. And of course, the big one, the health of the global economy. Is the world growing, or are we staring down a recession? These are the questions that are always on a gold trader's mind. Real interest rates, the nominal interest rate set by a central bank minus the rate of inflation, a key gold indicator. And here's the key: when that number is really low or even negative, it's often like rocket fuel for the price of gold. 3. Fear, the unique fuel. So we've established that fundamentals are the engine that drives gold. But what's the fuel? Well, there's a very specific, very powerful type of fuel that really ignites that engine and causes those massive moves. And it all comes down to one single emotion. And that word is fear. Plain and simple. Think about it. A strong growing economy is usually great for stocks, right? Well, gold is the opposite. It feeds on anxiety. When the world gets truly terrified, we're talking big recession fears, hyperinflation, war, you name it. That's when gold doesn't just rise, it surges. Fear is its ultimate catalyst. 2008 crisis, a case study. And there's no better example of this than the 2008 financial crisis. I mean, just think back to that time. The entire global banking system was teetering on the edge of collapse. The level of fear was off the charts. So in that environment, what do you think gold did? It went on an absolutely epic bull run. As that fear completely took over the markets, the price of gold nearly tripled in just a few years. And then, just as importantly, once things started to calm down and that sense of crisis faded, what happened? Gold's rally fizzled out and it went back to just moving sideways. We saw a mini version of this exact same pattern during the COVID pandemic back in 2022. 4. Traders' gravest mistake. Okay, so this powerful connection between gold and fear, it leads to what I think is one of the most important warnings you'll ever hear in the markets. This is a piece of wisdom that gets passed down from trader to trader. So let me ask you a question. What do you think is the second most dangerous trade you can possibly make in the financial markets? Well, pretty much every market veteran will tell you that number one is shorting the US stock market. Just betting against it long term is a recipe for disaster. But what comes in at a very, very close second? It's selling gold when fear is in the driver's seat. Trying to bet against gold during one of those fear-fueled rallies. And why is it so dangerous? Because when fear takes over, all logic goes out the window. The price can go way, way higher than anyone thinks is possible. It's like a runaway train. And if you try to stand in front of it, well, it's going to be devastating. 5. Calm versus chaos. So this really brings us to the main point of all this. To really understand gold, you just have to figure out which environment we're in. Because it really does have two completely different faces. Yeah, gold basically has two modes, calm and chaos. During confident times, when the world feels stable, economies are growing, gold gets pretty boring. It just chops sideways, maybe even drifts a little lower. But then you have chaotic times. When the world feels unstable, when there are fears of recession or war, that's when gold wakes up. It remembers its job as a safe haven and its price can absolutely explode. So what's the big takeaway here? It's that gold isn't just some shiny rock. When you look at it through the lens of the financial markets, it's really a barometer for global fear. A gold mental model. 1. Fundamentals. Gold is driven by economic data, just like stocks or currencies. 2. Fuel. Its primary and most explosive catalyst, however, is fear. 3. 2 speeds. It alternates between long periods of calm and short, explosive moves. 4. The rule. Fighting a fear-driven rally is considered extremely dangerous. Look, the world is rarely in total chaos, and that's exactly why gold can be so quiet for so long. But it's always there, always sensing the mood, and when things get scary, it remembers its role. So, the real question you have to ask yourself is, what is it sensing right now? Let's dive into one of the most fascinating and, let's be honest, one of the trickiest assets out there, gold. Today, we're going to pull back the curtain on its wild moves and break down 3 fundamental principles that come straight from a pro trader's playbook. I love this quote from our source because it just hits the nail on the head. Gold is exactly like that mechanical ball. It's volatile, it's unpredictable, and it can throw you off in a heartbeat. But man, if you learn how to ride it, if you understand its rhythm, the payoff can be absolutely huge. It's an incredible trading vehicle, but you've got to know the rules of the game. So that's the big question, right? How do you actually get on that bull and stay on? How do you navigate these massive, chaotic waves in the gold market without getting totally wiped out? Well, that's exactly what we're going to figure out today. We're going to build a solid framework for taming this beast. And here's our game plan. First, we'll get into the real personality of gold. Then we'll look at the fundamental drivers that make it move. After that, we'll cover a professional strategy for actually trading it, and we'll wrap it all up with 3 simple golden rules. So, Section 1, let's really get to know the true nature of gold and figure out why it moves the way it does. Look, if you only remember one single thing from this entire breakdown, make it this: gold trades on fear. That is the magic word. When the world starts getting nervous, we're talking recessions, out-of-control inflation, geopolitical drama, that's when investors sprint to gold for safety. And that fear is the rocket fuel for its biggest, most explosive moves. And this is just so critical to understand. You know, gold actually spends most of its time kind of going nowhere, just chopping sideways in a stable, confident market. It can be pretty boring, actually. But when chaos hits, when that fear takes over, that's when you see those massive one-way freight train moves. The trick is to know which environment you're actually in. And this slide, this just shows it perfectly. Take a look at 2008. The global financial system is on the brink of collapse. Fear is everywhere. And gold goes on an absolutely historic bull run. Then what happens? Things calm down for a few years, and gold just drifts sideways. But then, bam! 2020, the pandemic hits, fear is back, and gold just rips higher again. It's a textbook example of fear driving the market. Okay, so if fear is the fuel, what lights the match? Well, that brings us to the fundamentals, the specific economic signals that the pros are watching 24/7 to get a read on the market's fear level. You can think of these as the dials and gauges on a trader's dashboard. You've got interest rates, the health of the economy, inflation reports, central bank policies, and of course, those big geopolitical wildcards. Every single one of these gives you a clue about which way gold might be leaning. Let's start with interest rates, because it's one of the biggest drivers. The general rule is pretty simple. When central banks start talking about cutting rates or making money easier to get, that is usually very bullish for gold. But on the flip side, when they start hiking rates aggressively, that can create some serious headwinds for the gold price. But here's a pro-level tip. It's not just the headline interest rate you need to watch, it's the real interest rate, and that's just the interest rate minus inflation. See, when real rates are low or even negative, holding gold, which pays you 0 interest, suddenly becomes way more attractive. That's why the pros are obsessed with real rate data from places like the Fed and the ECB. And then there's the economic data. A simple way to think about this is that gold is kind of like a barometer for economic health. When you start seeing weak numbers, job losses, slowing growth, that's a sign that there might be a storm coming. And that's when investors rush to the safety of gold. Okay, so we've got the why and the what behind gold's moves. Now for the really important part, the how. How do you take all this knowledge and actually apply it with a professional strategy? This brings us to what might be the most powerful principle of all. You have to respect the momentum of gold. Once one of those fear-driven trends really gets going, it can go so much farther than you or anyone else thinks is possible. Our source actually told this great story about learning this lesson the hard way. He set a price target for a gold move, a 10% move, which he thought was pretty generous, but the market basically just laughed at his target and blasted almost 14% higher. It's the perfect reminder of why trying to be a hero and call the top is such a dangerous game and a strong gold trend. So what's the professional move? It's a technique called a trailing stop. Instead of trying to guess where the top is, you just let your profits run and you protect them. So you get into a trade, you set your initial safety net, your stop loss. As the price moves up in your favor, you manually move that safety net up behind it, locking in profit. It goes higher, you move it up again. This way, you stay on for the whole ride and you let the market, not your own fear or greed, tell you when it's over. And that leads to this final powerful warning from our source. I mean, it doesn't get much clearer than this. Trying to fight a powerful gold trend, trying to short it or sell it when it's screaming higher, is one of the fastest ways to blow up your account. You just have to respect that momentum. Alright, let's bring it all home and recap the 3 golden rules for trading gold. So, here you go, the entire framework in a nutshell. Rule number 1. Understand that gold is a creature of fear. Rule number 2. Keep your eyes on the fundamentals like interest rates to see if fear is building. And rule number 3. Once that trend starts moving, get on board and respect its power. Don't ever fight it. These 3 rules give you a complete mental model for approaching the gold market like a professional. And that leaves us with one final thought for you. Using this exact framework, take a look at the world around you right now. Look at the headlines, the economic data, the geopolitical tensions. What phase do you think the gold market is in? Are we in a period of chaos or a period of stability? Because the answer to that question might just be your key to figuring out where gold is headed next. Everyone, and welcome. Today, we're going to decode a really powerful signal that's often hiding in plain sight on a trading chart, the doji candlestick. Now, it might look pretty small, maybe even insignificant, but trust me, as we're about to see, it can be your first clue that a market's direction is about to make a massive change. I know, it sounds almost too simple to be true, right? But what I've learned over the years is that some of the simplest signals are actually the most profound. So let's jump in and see how this one specific little shape can give us a critical heads up that a trend is getting ready to turn on a dime. Okay, so before we start breaking down all the different types of doji, we first need to get a solid grasp on what every single one of them represents at its very core. And really, it all boils down to one simple but powerful word: indecision. So what is a doji exactly? Well, structurally, it's just a candle where the price opens and then closes at almost the exact same level. I mean, think about that. You've got a full session of trading, all that buying, all that selling, all that action, and at the end of it all, it's basically a draw. Neither the buyers nor the sellers could really take control, and this right here is the whole point. A doji is basically the market's way of slamming on the brakes and hitting the pause button. It's this moment of perfect balance in that constant tug of war between the bulls and the bears, and it shows us that whatever momentum was there before, well, it might be fading. And here's the real secret to using the doji's power. Think about it. If you see indecision in the middle of a market that's just chopping sideways, it doesn't really tell you much, does it? The market is already indecisive. But what if you see that exact same indecision at the very peak of a massive rally or at the absolute bottom of a steep sell-off? Well, now that is a huge red flag. This is why you'll hear traders say over and over that context is everything. After a really strong uptrend, a doji suggests that the buyers are finally getting tired out. And after a long, painful downtrend, it hints that the sellers might just be running out of gas. This is the exact moment when that tiny little candle transforms into a powerful reversal signal. Alright, so let's look at our first specific type, the gravestone doji. And yeah, that name alone should give you a pretty good hint about its ominous signal. Just take a look at its shape. It's basically an upside-on T. You've got this long wick sticking straight up and a tiny little body right at the bottom. This very distinct visual tells a really specific and bearish story about what just happened in that trading session. So here's the story behind it. During that trading period, the buyers managed to push the price way up. That's what creates that long upper wick, but they couldn't hold it there. Sellers came in with overwhelming force, and they slammed the price all the way back down to where it started. They decisively won that battle. It's a powerful signal that the uptrend could be over. Rest in peace. Now let's just flip that whole concept on its head and look at its bullish twin, the dragonfly doji. This one, well, this one signals a bit of hope after a downturn. And you'll see it's the exact opposite of the gravestone. This one looks like a perfect T, with a long wick pointing down and the body sitting right at the top. The story here is a complete mirror image. The sellers, they gave it their best shot, pushing the price way down and creating that long lower wick. But then the buyers stepped in. They soaked up all that selling pressure and drove the price right back up to close near the high. Now, after a long sell-off, this can be the market saying a bottom is in. But, smart traders will often wait for the next candle to close higher just to confirm the reversal has really started. Okay, our third type is a little more nuanced. It's the long-legged doji. And it really represents a much more balanced and, because of that, a much more uncertain fight. Its shape is pretty much a cross or a plus sign. You see, the open and the close are right near the middle of the candle's range, and it has a significant wick on top and on the bottom. So, this candle shows us that both the buyers and the sellers made a really strong push. The price went high, it went low, but in the end, it finished right back where it started, in the middle. This is like peak indecision. And because it could be a major reversal or just a quick pause in the action, the big takeaway here is you absolutely have to wait for the next candle to see which side wins the war. Okay, so we've broken down the three main types. Now let's just put them side by side so the differences are crystal clear, and then we'll look at a real-world chart. Alright, so let's do a quick recap. The gravestone with that long upper wick tells us the sellers won. That's a potential sell signal. The dragonfly's long lower wick shows us the buyers won, a potential buy signal, or maybe a good time to cover a short position. And the long-legged, with wicks on both sides, that signals a true battle, telling us, hey, be careful and wait for confirmation. Now let's see this in the wild on a live chart. Take a look at this 5-minute time frame. We see this really steep sell-off, right? 7 red candles just plunging downwards. Then, right there at the bottom, what do we see? A long-legged doji. It signals that exhaustion and indecision right after a strong trend, and sure enough, the market pulls a sharp V-shaped reversal and just rallies. And the story doesn't even stop there. After that first rally, look, another doji appears at the top, and it triggers a pullback. Then, right at the bottom of that pullback, there's another one, signaling the next move up. It's almost like watching a pinball machine, when the dojis are the bumpers at the extremes, just reversing the price direction again and again. It's a brilliant example of their power. So, if you remember just one thing from all of this, let it be this. A doji just kind of floating around in the middle of a sideways chart, it doesn't mean much. But a doji that appears at the extreme end of a strong move up or a long move down, that is a signal you absolutely cannot afford to ignore. Ultimately, recognizing these patterns just becomes second nature with practice. The more charts you look at, the more you're going to train your eye to spot these formations and just instantly understand the story they're telling. You'll see that moment of indecision at a market extreme, and immediately your brain will recognize it as a red flag for a potential reversal. So now you have the blueprint. You know what a doji is, you know what the different types mean, and most importantly, you know why context is the key that unlocks their predictive power. The signal is right there for you to see on the chart. The only question left is, what are you going to do with that information? Let's talk about something every trader sees, but maybe doesn't fully understand. We're diving into the doji candlestick, that little cross on your chart that can be a huge signal or just a bunch of noise. So you open up your chart and you see this. A total flurry of activity. Candles everywhere. Where in the world do you even begin to make sense of it all? When you're staring at a screen that's just littered with dojis like this one, how do you know which ones are actually important? Which ones are sending a real signal, and which ones are just, market chatter? It's a problem that can drive any trader crazy. To figure that out, we've got to go back to the basics. We need to be crystal clear on what a doji is actually telling us in the first place. A doji, at its heart, usually looks kind of like a plus sign. The price went up, the price went down, but when the dust settled, it closed right back where it started. Think of it as a perfect moment of balance, a total stalemate in the tug of war between the buyers and the sellers. The market is basically just taking a breath, trying to figure out what to do next, and it gets even more interesting. While the basic idea is always indecision, dojis come in a few different flavors. You've got the dragonfly, which kind of leans bullish because you can see buyers fought hard to push the price back up. And then you have its opposite, the bearish-leaning gravestone, where sellers clearly won the battle from the top. Each one tells a slightly different story about what happened during that trading period. Okay, so if a doji means indecision, how in the world do we find the ones that signal a decision is about to be made? Well, the secret isn't actually in the candle itself. It's about where, and more importantly, when you find it. And this right here, this is the key to everything. A doji on a 5-minute chart? Honestly, it's just a bit of short-term chatter, a brief pause. But a doji on a daily chart? Whoa, that's a completely different animal. That's a major announcement, signaling a potential long-term shift in the market. The longer the time frame, the more that indecision really truly matters. But why, right? What is it that gives the daily chart so much more significance? Let's really break down why these signals have so much more power. It's actually pretty simple. A doji on the daily chart carries so much more weight because it reflects a full day of battle. We're talking everyone from the smallest retail traders to the biggest institutions fighting it out. And when a fight that big ends in a draw, the move that follows tends to last for days, maybe even weeks, not just a few minutes. And what does that mean for you? Much larger profit targets. And just to put a number on it, our source material points out that a single doji popping up at a key level on Bank Nifty's daily chart could signal a potential move of 1,500 points. I mean, that's a scale of opportunity you are just not going to find on those noisy little intraday charts. So that's the why. Now for the how. How do professional traders actually take this knowledge and build a solid strategy around it? This quote really gets to the heart of the pro mindset. See, they don't get lost in the weeds hunting for random patterns on a 5-minute chart. No way. They always start with the big picture. They use that daily chart to map out the most important battlegrounds, the major support and resistance zones where the really big moves begin. The strategy itself is a super logical, top-down approach. First, you pull up that daily chart and you draw your map, your key zones. Then, you watch for dojis to appear right at those important levels. But, and this is probably the most critical part, you don't jump in just because you see a doji. You wait. You wait for the next candle to confirm the direction. That one simple act of patience will save you from so many false signals. Of course, a signal this powerful doesn't come for free. There's always a trade-off. So let's talk about the risks and the rewards that come with this approach. So the big reward is pretty obvious, right? We're talking about those massive profit targets. The trade-off is that you have to be willing to accept a little more risk up front. You'll need to use wider stop losses to give the trade enough room to breathe on these bigger time frames. You also have to be on the lookout for a classic market trap called SL hunting. This is where the big players will intentionally push the price just a little bit below a key support level. And why do they do that? To trigger all the stop losses from traders like us, which creates a pool of liquidity for them to fill their huge orders before they reverse the price and send it flying upwards. This is exactly why waiting for that confirmation candle is your absolute best friend. It helps you avoid getting shaken out right before the real move happens. So here's the bottom line. To really understand what the market is telling you, you have to zoom out. A single doji on a 5-minute chart is just a word. It's noise. But a doji on a daily chart appearing at a key level that you've already mapped out? Well, that can be the first chapter of a whole new story unfolding right in front of you.
Welcome to the Explainer today. We're going to build a complete blueprint for one of the most fundamental tools in all of trading the trend line. You know, so many traders draw them, but very few really master them and that well. That leads to a ton of confusion